Today's video is all about the importance of investments and the need and the benefits of investing from an earlier stage in life. So before we proceed to the video, don't forget to subscribe to my channel and like the video. It really helps. So first, let us know what is an investment. In general terms, investment means acquiring or buying income-generating assets. These assets work for you to make more money. A person buys these assets from the income earned from job, business, or profession. Basically, investment is making your money work for you. Investing your hard-earned money in assets which can sustain through your retired life is important. The relationship of a person with money is a lifelong affair, and one must have an efficient plan to save and invest according to their risk appetite. There are a lot of benefits of investing. Let us know about them in detail. First, let us know why should a person start investing. Well, there are 3 convincing reasons to start investing today. Let us know what they are. The first one is to handle the impact of inflation. This means to fight the constant rise in the prices and to be able to meet your daily needs. By investing, one can deal with the inevitable growing cost of living. And secondly, to create wealth. Investing smartly helps you to create wealth with great returns by the end of a particular time period. One can have a corpus fund in the end of retirement and can accumulate funds for children's education, marriage, house purchase, vacations, etc. The third and the most important reason would be to face uncertain events. Life is very unpredictable at times, and one must be ready financially to deal with such events. It might be the loss of the bread earner of the family, but if he has money, his family will be able to meet their financial needs. So one must always have money for such events so the family doesn't suffer. Now, let me tell you what happens when you choose not to invest your money. Let us assume you earn $40,000 a year, out of which you can spend $24,000 towards your everyday expenses and cost of living. Therefore, you will be left with $16,000 by the end of the first year. Now, let us assume that you choose not to invest that money and leave the cash as it is. Now the simple question is, how much money you will have by the time you retire? To keep it simple to understand, let us ignore the effect of tax and make a few assumptions. Your earnings are increased by 5% every year. The cost of living increases by 4% every year. You're 30 years old now and you plan to retire by 50. This means that you still have 20 working years left. You don't intend to work post-retirement. Now, let's do the math. At this rate, can you work it out with all the amount of money you'll be left with by the time you retire? Now here is the calculation. For the first year you earn $40,000. Your yearly expenses are $24,000, that is $2,000 per month. You save $16,000 for the first year. The second year you get a hike of 5% in your earnings, so you earn $42,000. At the same time, your expenses are increased by 4%. And so on and so forth. The numbers are quite scary, and here is why. After 20 years of hard work, you accumulate $600,000. Your expenses are fixed, your lifestyle has not changed much over the years. You probably even suppressed your lifelong aspirations like a better home, a better car, vacations, etc. Now, after retirement, assuming that expenses will keep rising by 4%, in this case, $600,000 are good enough to sail you through 10 years of retirement life. But from 11th year onwards, you have no savings in your bank account to back you up. So now the question is, what would you do when you're left with no money to spend in your retired life? Is there a way to ensure that you accumulate a larger sum at the end of 20 years? Now let us see this in a different way. Instead of keeping your money idle, you choose to invest your money in an investment option which grows at 12% per annum. For example, for the first year you retain $16,000 and invested at 12% per annum for the next 19 years. The second year you retained $17,000, which again invested at 12% per annum for 18 years. Likewise, you kept investing the cash that you retained at 12% per annum every year. The table below will help you to understand how the numbers grow. At the end of 19 years, the first year's investments of $16,000 grows to $137,000. This is a 12% CAGR, compounded annual growth returns. Likewise, the second year's investments of $17,000 grows to $131,000. If you add up all the final values, you get a massive corpus of $1.7 million, which is interestingly 2.8 times higher than what you could have otherwise saved. Clearly, this is the reason you need to invest today. Now that you have decided to invest, the question that must arise in your mind is where to invest your hard-earned money. Well, there are a number of investment options for you to invest in based on your risk-bearing capacity. Let us see what they are. The first in the list would be equity. An equity investment is the money that is invested in a company by purchasing the shares of the company in a stock market. These shares are typically traded on the stock exchange. The main benefit from an equity investment is the possibility to increase the value of the principal amount invested. This comes in the form of dividends and capital gains. Another great option would be the S&P 500 index funds. If you want your portfolio's value to grow with the US economy and don't want to choose individual stocks, an S&P 500 index fund could be a smart choice. In fact, legendary investor Warren Buffett has said that investing in low-cost S&P 500 index funds is a bet on the future of the US and the best way for most of the people to build wealth. Similarly, the Nasdaq 100 index is a basket of 100 largest and most actively traded US companies listed on the Nasdaq Stock Exchange. The Nasdaq 100 is one of the world's preeminent large-cap growth index. It includes 100 of the largest domestic and international non-financial companies listed on the Nasdaq stock market based on the market capitalization. It is home to the 4 companies who have touched the $1 trillion mark in the US. That is Apple, Amazon, Microsoft, and Alphabet. The next investment option in the list would be mutual funds or exchange-traded funds. A mutual fund is a type of financial instrument made up of a pool of money that is collected from investors to invest in securities like stocks, bonds, money market instruments, and other assets. Mutual funds are operated by professional money managers who allocate the funds into assets and attempt to produce capital gains or income for the investors' funds. Whereas, an exchange-traded fund (ETF) is a type of security that tracks an index, sector, commodity, or other assets, but which can be purchased or sold on a stock exchange in the same way as a regular stock. An ETF can be structured to track anything from the price of an individual commodity to a large diverse collection of securities. ETFs can be structured to track specific investment strategies. The next is one of the safest investment options in the list. It is real estate and rental income. Buying a commercial property is always a good investment, but one must be smart and buy a property that is worth the money. So there is a chance that the price of the property could go up. You can even receive rental income on such properties from the tenants whom you lease the property. This is one of the safest investment options, but one must be really smart and select a property based on the location, place, value, etc. The next in the list is cryptocurrency. It is one of the most trending investment options worldwide. Cryptocurrency is a form of payment that can be exchanged online for goods and services. Many companies have issued their own currencies, often called tokens, and these can be traded specifically for the goods or service that the company provides. Think of them as you would arcade tokens or casino chips. You will need to exchange the real currency for the cryptocurrency to access the goods or services. Cryptocurrencies work using a blockchain technology. Blockchain is a decentralized technology spread across many computers that manages and records transactions. Part of the appeal of this technology is its security. Now you guys clearly know why you need to invest your money. So don't wait guys, start investing your money today. But before that, do all the analysis before investing in an investment option. Thanks for watching the video. Don't forget to subscribe to my channel and like the video.